The government wants to lower the interest rate you pay to borrow money. Sounds good, right? Ted's here. We're going to discuss it. Let's begin.
This is Debt Free in 30. Here's your host, Doug Hoyes.
Okay, Ted, welcome back. Today we are going to talk about the criminal code, one of your favorite topics, I know.
On the advice of counsel, I cannot answer any questions today.
Talk about it. So the government of Canada has said, you know what? Interest rates are too high. We're going to lower them.
Right.
The criminal code says, here's the limit. We're going to make that lower. So I would like you to start by telling me in layman's terms, I'll actually read it, but in layman's terms, what is section 347 sub 2 of the criminal code say? What cap does it put on it?
Well, so it says that you cannot charge more than 60% interest.
Okay, so that's pretty simple.
So on the surface, that seems pretty straightforward. It just gets more complicated in the details.
So the details.
It's always the devil's in the details. Right.
So section 347 says 60%, and the government says that's too high. They want to lower it. So I'm going to quote from the federal government's backgrounder. You can go to the Canada Gazette where all this stuff gets published.
Which everyone reads every morning with their coffee.
It's the greatest thing ever. So here's what it says, and I quote, "The criminal interest rate was first introduced in section 347 of the criminal code in 1980. I didn't know that. I would have thought it was, before that.
Forever, yeah.
The amendments introduced as part of the Budget Implementation Act 2023 represent the first significant update to the criminal interest rate regime since 1980.
Since it was done.
It was done. So nothing has changed since it happened. The criminal rate is applicable to virtually all credit agreements and arrangements in Canada, including installment loans, lines of credit, auto loans, auto title loans, credit cards, and more. Yeah, that's pretty much everything.
Except
the criminal interest rate provisions do not apply to transactions under the Tax Rebate Discounting Act. So that's
an actual law.
That's an actual law. So I go to the tax preparer and they say, yeah, you're eligible for a refund of $1,000. We'll give you X number of dollars of it right now.
Right.
So we are not a big fan of that because you're going to get your refund in 7 days anyways. Do you really need to pay a huge fee for that?
Correct.
So as a result, yes, there is a Tax Rebate Discounting Act to cover it.
And the other thing?
Payday loan agreements.
Do you believe this stuff?
I do. This later exception for payday loans was enacted through amendments included in the former Bill C-26 in 2007. So that's when this all came into be. Now, I know that you are a wonderful believer in payday loans, so we're gonna talk about that. But let me give a bit more context. And again, I will quote: in 2007, Section 347 of the Criminal Code was amended to provide an exemption from the application of the criminal rate provisions for payday loans, provided certain conditions are met, such as the loan's $1,500 or less, and it's for a term of 62 days or less. That's their definition of a payday loan. And it has to be issued by a licensed lender, someone who's specifically authorized, whatever. In order to receive this designation, a province must have in place legislative measures that protect payday loan users, and must provide for limits on the total cost of borrowing for payday loan agreements. Every province has this except for
Quebec and the territories, right?
Yes, and I guess I don't know whether
that's not a province.
I guess they're not really a province, but yes, if you're in the territories or Quebec, then you are subject to the criminal code interest rate of 60%.
And this 1,562 days, none of that stuff applies, right?
That's right. So now if you're in Ontario, then a payday lender can charge
$15 every 2 weeks.
$15 on every $100 borrowed.
Right.
So you're right. If I get a loan every 2 weeks, I borrow $100, I have to pay back $115.
Right.
And if I keep doing that over and over and over, then 26 times during the year, I've borrowed $15 on my 100. So I've paid $390 on my $100 loan.
That's right.
And that to me is a 390% interest rate. I know the payday loan people don't agree with me on that. So in 2021, your friend, the Prime Minister,
we're buddies,
told the finance minister that he wanted her to crack down on predatory lenders by lowering the criminal interest rate in the criminal code. Okay, well, that sounds good, right? Nobody's going to disagree with that.
It's motherhood.
Motherhood, absolutely. Budget, again, I'm going to quote one more time here. Budget 2023 announced the government's intention to lower the criminal interest rate to 35% APR from 60% EAR. Okay, so we're going to have to figure out what that means. And to set the maximum cost of borrowing for payday loans at $14 per 100 borrowed. Okay. So consequently, the Budget Implementation Act introduced the legislative amendments to lower the criminal interest rate to 35% APR. The amendments also included 2 regulation-making authorities to provide exemptions for certain types of loans and to fix a limit on the total cost of borrowing for a payday loan agreement. These provisions received royal assent with the passage of the Budget Implementation Act 2023, but are not yet in force.
Right.
Now, this is something I did not understand. I did not understand that when royal assent happened, it still wasn't done.
So conceptually, royal assent means, yes, we've approved the law, but it hasn't come into effect yet.
Right. And we talked about this on the coerced debt podcast because it was the same thing with the Ontario law. It's received royal assent, but has not come into force yet. So the government has just concluded the consultation period on the proposed regulations.
I don't remember them asking me.
Well, sure, they sent an email to everybody. And I looked at it, I said, I'm not going to even bother. I'm not even going to bother wasting my time sending something in. So now we get to see what was happening. Okay, so that's the background. That was a great 5 minutes of radio. So now let's get to the real meat of this. First question, what is the deal on the interest rate?
Okay, so how does that 60 actually somehow get converted to this new 35?
Right. And
what's the 60 mean?
What does the 60 mean? And I'm a smart guy. I didn't understand it. So what I did was I went to ChatGPT and started asking it questions, and it gave me a bunch of wrong answers. So finally what I did was I took
That was free, right?
It was free, yeah. So I took a pencil and a piece of paper and made a spreadsheet, and here's what I did. So if the interest rate is 60%,
right,
you're going to do the math in your head here. That would sound like a monthly rate of 60 divided by 12, which 5%. Is right. So, okay, 5% a month, 60% a year sounds like the same thing, but it isn't.
Right.
Why is it not the same thing?
Well, if you carry that value forward every month, then you're actually paying interest on the interest, the compounding effect.
Compounding. Right? So that's the answer, compounding. So I borrow $1,000 at a 5% per month interest rate. The first month, if I'm not paying anything back, the interest is $50.
Right. So now you owe $1,050.
Right. And so then the next month, I have to pay 5% on $1,050, which isn't $50, it's $5,250.
Right.
And it just keeps going up and up and up. So when I did the math, my $1,000 at a 5% per month interest, at the end of it, I would have to pay back at the end of a year almost $1,800.
Right. So 80% interest.
So 60% is really 80%.
Mm-hmm.
More specifically, 5% per month isn't 60%, it's 80%.
Right.
Okay. Now I'm starting to understand.
So now you got to work
it
backwards to figure out what actually is legal.
Right. And so I did that. I went to a spreadsheet and I said, okay, instead of 5% a month, let's make it 4% a month and see what happens.
Okay.
And sure enough, when I make it 4% a month, at the end of it, I've paid just over $600 in interest on my $1,000 loan.
So I guess it's 3.9999.
Exactly. It's just a little bit under.
Right.
So 4% a month times 12 would be roughly 48% a year.
Right.
So when you read all the government's backgrounder papers, they say that we are lowering the interest rate from, it was 60%, but that was really 48%.
Right.
That's where they're getting this 48%.
That's that EAR versus APR.
Right. So the APR is what you actually end up having to pay.
Which is the only one you should be interested in, folks.
What do I really have to pay? That's all I care about. So we're not going to mention names here.
We're not?
No.
Okay.
So I don't want to get sued.
You don't want to offend a sponsor?
Right. We don't have any sponsors, but someday we will.
Right.
What is this, episode number 492 or 91 or something like that? Yeah. So here's the deal. We see loan documents all the time.
And we see the regular banks, and we see the subprime and the subprime, and you shouldn't be dealing with this guy because his name is Guido, right?
Right. And so the subprime guy is, and they're all huge companies,
right?
And their names are very well known. And when you look at their loan documents, the interest rate is something like 45%.
Yeah. I mean, we were talking this morning. We think 46.99 is the highest any of us have seen.
Which coincidentally is just under 48%.
Right.
So that's why they're not charging you 50%.
Well, that's why they're not charging 60%.
Or 60 or higher. Yeah.
They've done the math.
They've done the math, and that's what it says. Now, there is something called the Canadian Lenders Association, which is not the Canadian Bankers Association.
Right.
That's different. It's not the Payday Loan Association. That's different. This is the Canadian Lenders Association, which represents over 300 companies across Canada that lend to the consumer and other sectors, but they don't represent the payday lending sector. Let's be clear about that here.
There might be some cross membership, you think?
No,
we're not looking at that at all.
They do not represent the payday lending industry. So they're in that middle group, that kind of subprime. So, and I'll put links in the show notes to the Canadian Lenders Association, but they say that over 8 million Canadians have credit scores below 720.
So that's a third of all Canadian adults.
That's a big number.
Yep.
That make them non-prime and subprime, meaning they can't go to the bank and get the best interest rates.
Okay.
Without access to installment loans offered by alternative lenders, everyday Canadians with non-prime credit scores have few options when it comes to accessing loans for essential expenses, having to rely on payday loans or worse. That sounds bad.
I wonder what the or worse is.
Ooh, Guido.
Guido on the shop floor.
Right, you already said that.
I'm going to make you an offer you can't refuse.
And you do have Greek and Italian heritage, I think.
That's
don't
right.
you? So
Sicilian, I believe, is what you're looking for.
That's what I'm looking for. So he's not being racist here, people.
That's right.
He's just quoting from
picking on myself.
Picking on his own people. Alternative lenders provide an opportunity for everyday Canadians to repair their credit score and eventually qualify for bank loans at lower interest rates as they report loan payments to the credit bureau. Okay. Guido probably doesn't.
Probably not.
Alternative lenders are not payday lenders. We want to be very clear about that.
Alternative keep lenders. Saying that. How many times are you going to say that?
Well, I'm reading from their own press release.
Yeah. Got it.
Alternative lenders offer installment loans at lower rates to borrowers compared to payday loans and report the borrower's repayments to the credit bureaus so Canadians can rebuild their credit score. Okay, they sound like wonderful people here. So the alternative lenders say they're helping Canadians that wouldn't otherwise qualify for traditional bank lending because it's cheaper than payday loans.
Right.
Longer repayment times, because a payday loan, we already said, is maximum 62 days. And in a lot of cases,
and
it's
for 2 weeks.
Week or two, And it helps them rebuild credit. Okay, this all sounds wonderful. They say the government should not lower the criminal interest rate because the Lenders Association estimates that about half of the non-prime customer base, or more than 4 million people, currently face interest rates above 35% because of their credit risk profile and would therefore be at risk of losing access to traditional credit under the new rules. Okay. So I think we now see where this is shaking out.
Where it's going, yep.
There are two sides to this discussion. So on the lender's side, they're saying, look, for high-risk creditors or borrowers, we have to charge more.
Right. You got to pay more because there's more risk.
Because there's more risk. Okay. Let's go on a tangent here. Let's say that your buddy from high school, in fact, you've known him since you were 3, one of your oldest friends. He calls you up and says, Ted, I need to borrow $20 because I left my wallet at home today. You're going to go, fine, here's $20. Sure. Not even going to think about it. Okay, let's say that same guy who, again, best friend, you've known him forever. He says, Ted, I was off sick for a week, so I'm not getting a paycheck this week. I need to pay my rent. Can you loan me $1,000? I'll pay you back over the next, few weeks.
Right.
So you go, okay, well, I had $20 in my pocket. I don't have $1,000 in my pocket. So I'm going to have to go online to my, line of credit and borrow the $1,000. But yes, I will lend it to you, but I'm going to have to charge you something because number one, I'm paying something on my line of credit and there's a little bit of risk here.
Right.
So your line of credit is 10%. Maybe you say to your buddy, fine, I'll loan it to you at 10%. Maybe you say 12%, whatever. Okay. Third scenario. Somebody else who isn't your best buddy, maybe it's, somebody casually, it's the parent of one of your kids in dance school or whatever.
Doesn't really matter.
They come to you and say, hey, Ted, same scenario, can I borrow $1,000? And you go, okay, well, this is a little riskier, so sure, I'll lend it to you, but the interest rate's going to be 15%.
Right.
Or 20 or whatever. Now, if it's somebody 12 levels removed from you, the friend of a friend of a friend of a friend.
It just keeps getting higher and higher.
Exactly. Yeah. Because you're pricing it for the risk.
Yep.
That's just kind of how it works. So if I'm a bank and I'm putting a mortgage on your house and your house is worth $1 million and you want to borrow $200,000, there is virtually no risk there.
Right. I got to season sell the house, but I'm going to get my $200,000.
So I give you mortgage interest rates, whatever they are now, 5%, 6%, whatever.
Right.
If you've already got 80% of the loan to value on the mortgage on the house and you want to borrow another 10%, okay, well, I'm going to charge you a higher rate because now the risk is higher.
Significantly higher.
Significantly higher. Now, if it's a credit card, okay, well, there's nothing backing it up.
Right.
So I'm going to charge you 20, 22, 24%. If it's an installment loan, a payday loan, whatever, the higher the risk, the more I charge.
Right.
Like, isn't that the way the world works?
That's the logic.
That's the logic of it. So I understand what the lender's saying. The higher the risk, the more we're going to charge.
And from a market perspective, if somebody thought that they could charge lower rates and recover as much money, they would. I mean, that's how competition works, right?
Yeah. Yeah. And you see it with mortgage rates that they're we got a special on where, highly discounted or whatever. You shop around for mortgage rates. I mean, you do the same thing when you're putting gas in your car. Well, if that station across the street's a cent liter, I'm going there.
Right.
Right. That's just the way you do it. So the lenders are saying, look, we are charging the interest rate we are because we got risk.
Right.
That's where we're coming up with it. And if we can't be compensated for that risk, we're not going to lend to them. And all that's going to do is drive those people to payday loan lenders. And that's even worse for them. And because they're going to payday loan lenders or your buddy Guido, they're not going to be reporting to the credit bureau. It's not going to repair their credit.
And remember, this isn't our position, folks.
No.
We're telling you what the lender's argument is.
Right. Okay, so let's look at the other side then.
Right. So this is the borrower's argument.
So from the borrower's side, it's like, wait a minute. You're a big bank.
Right.
And you're charging me that interest rate because you can.
Mm-hmm.
Simple as that. And so, sure, you could still make money if the interest rate was 30%, but you're going to charge me 40%.
Right.
It's just capitalism. Mm-hmm. It's as simple as that. And, let's face it, you, Mr. Alternative Lender, you're going after and charging more money to people who are, new immigrants, young people, somebody who...
The third of Canadians that only qualify for subprime.
Right. And so you've made this your market. You're going specifically after those people and making more money off them because of their situation.
Right.
And so just because someone is a new immigrant or the young or whatever, they still got a good job. They could still pay it back. But you're saying, no, I'm hammering you.
I got no history. I got no proof. I don't know who the hell you are. Then so this is what we're going to do.
Right. And they're using credit scores to do this. And we all know that credit scores are imperfect at best.
Right.
Right. Because they don't reflect everything. I mean, I've paid my rent on time every day for the last 5 years. That's not showing up on my credit report.
Well, and if you don't use credit at all, nothing shows on your credit report. So you could have no history because you've been very prudent, very, very conservative with your money. Well, suddenly you decided you need it for some reason. You've never had a default on a loan because you've never had a loan.
Yeah, you have to play the game.
Right. That's a whole different show we should probably do on how to play the game.
Right. But, if you, in your example, you're Warren Buffett, you've got $1 million in the bank. He's probably got $1 billion in the bank. I don't care what.
That's in his checking account.
In his checking account, right. Probably in his pockets. I don't care how much is I'm not borrowing any money. I don't need to. So his credit score maybe isn't perfect.
Right.
Whereas the guy who's got 4 different credit cards and he pays them off and uses them and circulates the money around, he might have a higher credit score because he's playing the game. That's what we're talking about. So, okay, let's game theory this out here. What do you think is going to happen? So this law is not in force yet.
Right.
But let's assume that the criminal interest rate, the effective, the APR, the actual rate, goes from 48% down to 35%. Right. So all these alternative lenders who are charging 45% on their loans can no longer do that. What do you think is going to happen?
So they're telling us that they will stop lending to a whole bunch of people. They'll no longer have access to credit. I think it's more likely that any people that have been getting loans in the 20s are now all going to get bumped to that 35%. And so that we'll see a shift of the cost of borrowing for this category or segment of the market to this 35. So the 48, okay, we've dropped that off the table. We're saving for some people, but collectively they still want to make the same amount of money, so it's all going to shift. And the other option is, of course, they're going to increase the size of the minimum loans. So they got to make the same money by lending you more money.
So let's talk about both of those things then. So, okay, so they were willing to loan to me at 30%.
Right.
Because I've got, okay credit. But now that they can't do that loan to that guy at 45%, when I come in, they're saying, hey, guess what? For you, it's now 35%.
Right. The government just made this change. That's the limit. So that's what we're going to charge.
Right. So this is actually great for those lenders because they've got an excuse now to raise the rates for
some of
everybody.
Right.
So that's okay. That's definitely a bad thing. And the other thing you said was, well, maybe they'll just increase the size of the loan. So that, again, that guy who they're willing to lend to at 35%, who they would have given an $8,000 loan to before, well, you know what? Why don't you take 10? Why don't you take 12?
Yep.
Because you're a lower risk borrower, and we can now make more money off you. And there is precedent for that.
Sure.
And the precedent, of course, is your friends in the payday loan industry. Because we already said in Ontario right now, the limit is $15 on 100. Well, it used to be higher.
Right.
It used to be $21, and then they lowered it to 18, then they lowered it to 15.
Well, they were forced to lower it.
Well, yes, it was not out of the goodness of their hearts. It was It was legislation. So when they were charging $21 on 100, it's like, you know what? We do $1,000 loans, $1,500 loans. That's it. Boom.
Right.
But then when the rate got knocked down to $15, it's like, well, now we're making less money. So what do we do? We got to lend more.
Right.
So now the payday lenders not only have payday loans, but they also have installment loans.
Mm-hmm.
So you can go to your favorite place and not just borrow 1,000, you can borrow 5,000 or 10,000.
And pay it off over 6 months or whatever.
Right. So the interest rate is lower.
Yeah.
They're only charging you 45%.
Instead of 390. Remember that, folks.
But they're charging it to you for 6 months or a year on a much higher number. So they're still making really good money.
Right.
And so it's very possible that that's what happens here.
Yeah. I mean, the thing that I find most interesting of all of this, so they're saying a third of Canadians are subprime. Well, that's consistent with a third of Canadians own their home. A third of Canadians are in decent shape, and the other third are living paycheck to paycheck and are in trouble. So we're talking about the bottom third of Canadians that are living paycheck to paycheck. Will this actually have any positive impact on them? I'm doubting. I mean, politically it sounds good, but I don't know if it's going to make a difference.
Yeah, and I am not a big supporter of, well, let me say it a different way. What problems has the government ever solved?
Right. Well, and what problem is this solving?
And what problem is this solving? So, I mean, is the post office the beacon for everything that is right in society? I mean, that's a government thing, right?
We don't usually pick on the post office.
Nah, I got nothing against them.
Okay.
They're all doing a fine job. So, but you're right. What problem is it designed to solve? Well, the problem is that there are lenders who are charging, 45%, and they should only charge 35%. Right. That's the problem. Okay, but could you not extend that to absolutely everything then? Mm-hmm. So why is there not limit? Okay, a third of Canadians are potentially borrowing under these terms.
Right.
100% of Canadians buy food.
Right.
100% of Canadians use some form of energy. We either, put gas in our car or take the bus or whatever. So if you want to help me, why not make a law that says the price of bread cannot be more than 10 cents?
Right.
And a liter of gas can't be more than 50 cents. Like, why wouldn't you do that? And the answer is, well, because it costs more than 10 cents to produce the bread and it costs more than, 10 cents to make a liter of gas. So there's reasons why we don't put caps on those things. Well, it costs money to lend money too.
Right.
And so let's say 20% is what the maximum interest should be. I know that's not what the law says.
You're just picking a number.
I'm picking a number. Well, in fact, I'm not picking it at random. There's a poverty advocacy group that has said that. They should cap it at 20%. Okay, well, so why doesn't that group just start their own bank then?
Right, just start lending.
Yeah. In fact, you don't even have to make it a bank. Do it on the side, do it whatever. Because the government does not set a minimum. Mm-hmm. You can do whatever you want, right?
Right.
So I'm not convinced that this solution is a solution that is actually solving a problem that couldn't be solved in many other ways.
Well, if there was pressure to do it, because I mean, the example, why aren't they doing it? Because I'm pretty sure there aren't any billionaires that are in that social services group.
That's correct. But again, if you want to lend to people at lower rates, well, you can do it.
Right.
Find some like-minded billionaires who are willing to fund it.
And see what happens.
If the interest rate was 20%, that's still a really high number.
Well, and it's a great rate of return.
It's a great rate of return. So the billionaire right now is investing in, T-bills and earning 5%.
Right.
If they could invest and earn 20%, why wouldn't they? And the answer is, well, because the loan losses would be presumably pretty high. So yeah, I'm not convinced that this is actually going to help. Now, whether the law will actually come into force or not, I don't know.
Well, it can be buried in regulations forever. I mean, that's the beauty of any of this stuff. We pass the law and nobody ever asks, well, how come it hasn't been implemented?
Right. And it hasn't been a big topic on the media.
Well, because we're all crazy right now because of the inflation rate. I guess this would have an impact on the inflation rate probably after it ripples effect through. But as you say, it was $7.59 for 18 eggs at the supermarket yesterday. Wouldn't I be happier if it was $5? I mean, that'll have a greater impact and people will notice it more than they'll notice this.
You're buying the fancy eggs.
So fancy eggs.
Oh yeah, you want the the ones
the no-name eggs
that are grown in a meadow or something. But yeah, you're absolutely right. Then, so I don't know. I mean, I don't think this has received a whole lot of media attention. I don't believe I've been interviewed on it, and I get interviewed all the time. I don't think I've been interviewed on this specific topic. So I guess if the public isn't clamoring for it, then you're right. The government says, well, we did something and
put it on the back burner.
And before the end of next year, there'll be an election and things will change anyway. So, okay, we are not here to advise the government. I mean, I think if we were advising the government, we'd say, we don't really care what you do. Like, do whatever you want. I don't know that it really matters. We are here to advise individual people.
Yep. We're trying to help people with their debts.
Right. So let's finish with some practical advice then. So if you are struggling with a loan at a 45% interest rate and you're waiting for the government to lower it, which isn't going to happen anytime soon, are there better things to think about? Have you got any other ideas for the listener?
Well, I mean, first and foremost, and we say this all the time, avoid debt. So if you don't incur debt, then you don't have to worry about these interest rates and any of these problems. Remember, interest is what they're charging you for using somebody else's money today. So you're paying them back with the hours that you're working tomorrow. Does that make any sense?
Well, it's costly.
Yeah.
That
means
the
you're working
problem.
tomorrow for somebody else instead of for yourself.
Yeah, and this is the problem I have with the government rules. So the problem is not that interest rates are high. That's the symptom of the problem.
Right.
The problem is we got high inflation, we got high expenses, there aren't enough good jobs, I can't find a place to live. You know, and we can,
and we all want to keep up with the Joneses.
Yeah. But, and I guess we've always wanted to do that, but is it the listener's fault that inflation was at 10% for many months in 2023? I don't think so. Maybe it was. I don't know. I don't know if the governor of the Bank of Canada is watching this or not. I'm sure he
You want the long-term perspective? The listeners that vote in the government spends the money, government spends more money, interest rates go up. So
well,
I guess
and that's
depends on where you want to draw the line.
That's kind of how it all works. Interest rates are higher. Inflation in particular is higher now than it was because the
government
increased
gave
the
away
money
a
supply. Yeah, it's
a boatload of money.
It's a pretty direct relation. So maybe what the government should be doing is looking at the root causes of the problem.
Yeah.
And addressing those as opposed to leaving the root causes and then just treating the symptoms. However, I'm digressing.
So back to the practical advice.
So I agree. Avoid debt wherever you can. So rather than getting a payday loan because your rent is due on the 1st and you don't get your paycheck until the 3rd, you're better off probably talking to the landlord and saying, look, I'm really sorry. I'm going to be 3 days late.
Right.
And I don't think they can evict you for being 3 days late. And then you want to come up with a plan to not have that problem in the future.
And on top of that, even if they want something extra, it'll be less than the payday loan guy wants.
Right. So look, I'll give you an extra $20 when I pay my rent or something. I don't know if that's legal, but find out other ways. Okay, if I got to take in a roommate, I got to find a part-time job, whatever it is.
Yeah. Make sure you understand how interest works and what's being calculated. So read the fine print whenever you're signing a contract. If something says that the interest rate is X, well, the example, the law right now says the maximum they can charge you is 60. Well, that really means 48. And how does all this going to be charged to you? What are the admin fees? Is there an insurance cost? Are there process and handling fees? What are they actually sticking you for? Make sure you understand all that.
That's one of the other things I worry about with this new law. Are they going to bury a bunch of fees? And we did read the law, and the law says that interest includes everything. You can't just be making up fees and throwing them in there. But
you need to understand that's how it works.
Exactly. So you go to this subprime lender place and they say, hey, no problem. We can give you a loan and it's only going to cost you $150 a paycheck.
Right.
Okay, $150. That's not very high. I can do it. That's irrelevant.
Right.
What's more relevant is, okay, multiply the 150 times. How many times you're going to have to pay it back? Mm-hmm. And what you find out is that your $6,000 loan is actually costing you $12,000 or $15,000 or whatever it is. So I totally agree with you. And it's not just reading the fine print. It's what are the numbers?
Yeah, you got to understand all this stuff works.
Because you may make a different decision.
The marketing people now are getting very good at, this is the payment. You can afford it. Mm-hmm. Well, you need to know not just what the payment is, but what's the cost.
Right. If they said to you, you're borrowing $6,000 and you're going to pay back $15,000.
You probably wouldn't borrow it.
Okay, going to let me think about that.
Yep.
So I totally agree, definitely understand it. Now, the reason I'm going to one of these places is because I got a credit card and I got this and I got that and I'm trying to consolidate and all the rest of it. What are some other options that perhaps I should be thinking about? Give us the commercial here.
All right, folks. Well, look, if you've got more debt than you can handle and you're finding your cash flow just doesn't match your servicing obligations for your debt, you should talk to a professional. Maybe you want to do a consumer proposal where you repay a portion of what you owe without any new interest at all. It's going to reset your credit, get you started on the right foot again, as opposed to borrowing more debt at higher and higher interest rates to try to solve the problem that way. That kind of thinking got you into trouble. Let's find a different way to think about this to get you out.
Yeah, and we totally get it. It's not your fault. I mean, you got laid off during the pandemic and you haven't been able to get back on track. And so you found another job, but you're behind and so you've borrowed money and so on. And that's totally understandable. But is the solution to debt more debt?
Right. And it almost never is.
Almost never is because of compounding, which is what we talked about earlier. So rather than taking on that loan and ending up paying back double, maybe you should be looking at other options, such as you said, a consumer proposal.
Make it simple on yourselves. If you go to the bank and ask to borrow money and they say, no, you're a bad risk, then start looking at all the options, including talking to someone like Doug or myself.
Yeah. And again, when you talk to a licensed insolvency trustee, there's no upfront fees. Obviously, we're biased. We want you to do the consumer proposal because that's how we make our money. But it's less than a third of the people who come to us actually end up filing.
Right.
Because we're going to walk you through the options. And if the answer is, hey, you got that second car that you never drive, sell it and pay it off, we're going to tell you that. So understand your options and you will probably be in better shape because you don't get out of debt by having more debt. So,
right.
Ted, there you go. Thanks for being here. We'll do a follow-up show if and when the law is actually passed, and then we can look at what all
the rules are put in place,
what all the unintended consequences are. So, as all our frequent listeners know, we have a new show every Saturday morning. It's on YouTube. We're on YouTube right now. You can wave to the crowd there, Ted. And the audio version is on all the podcasting apps, Spotify, Apple Podcasts, and so on. So please like, subscribe, leave a comment. And I'm sure some of you will have disagreed with what we're saying and saying the government's completely right in what they're doing. So fine, leave a comment on YouTube. And of course, hit the notification button so you are notified of each new show. That is our show for today. Thanks for listening and watching. Until next week, I'm Doug Hoyes. That was Debt Free in 30.